Listen to me very carefully, because I am only going to say this once. And whether you take action after hearing it is the difference between building generational wealth and watching your savings get quietly incinerated by a system that was never designed to protect you. The Federal Reserve just sent a signal, not loudly, not on the front page of every newspaper, but in the numbers, in the yields, in the dollar index, and in the price of gold. And if you own gold and silver right now, or if you have been sitting on the fence, too scared to pull the trigger, this is the most important 30 minutes of financial content you will watch all year. I have spent decades on Wall Street. I have seen bull markets, bear markets, crashes, and recoveries. What is happening right now is not a correction. It is not a blip. It is a fundamental restructuring of the global financial order. And the people who understand what I'm about to tell you are going to come out the other side wealthier than they ever imagined, while everyone else scratches their head wondering what happened to their retirement account. If you are watching this channel for the first time, let me be blunt with you. The advice I am about to deliver in this video is the kind of insight that professional money managers charge tens of thousands of dollars a year to provide, and most of them still get it wrong. You are getting it for free. All I ask in return is that you hit the subscribe button right now before we go any further, because every video I put out is built on the same foundation of raw mathematical truth. And if you are serious about protecting and growing your wealth, you cannot afford to miss a single one. Subscribe now. It costs you nothing except the ignorance you have been carrying around. Now let us talk about what the Federal Reserve is actually doing, because there is what the Fed says, and then there's what the Fed means. And those two things are almost never the same. The Fed has been holding interest rates at elevated levels, and the market has been behaving as though that posture is inherently bearish for gold. Every time oil prices tick up because of the Iran conflict, every time there is an escalation in the Middle East, traders have been reflexively selling gold and buying the dollar, as if a tighter Fed automatically means gold goes down and the dollar goes up. That logic is lazy. It is historically illiterate, and it is going to cost the people who act on it an enormous amount of money. Here is the reality that the market is missing. And I want you to write this down, because it is the single most important concept in this entire discussion. Nominal interest rates are irrelevant to gold. Say it again. Nominal rates are irrelevant. What matters? The only thing that has ever mattered in the relationship between interest rates and gold is real interest rates. Real rates are what you get when you subtract inflation from the nominal rate. And right now, with inflation surging by virtually every honest measure, with food prices climbing, with coffee prices at levels nobody anticipated, with fertilizer costs feeding through into every agricultural product on earth, with fuel costs embedding themselves into the cost of transporting every single good in the global supply chain. Real interest rates in 2026 are going to end up dramatically lower than anyone projected at the beginning of this year, lower than what 2 or 3 Fed rate cuts would have produced, lower than what the bond market is pricing. And when real interest rates fall, gold does not politely go up a little bit. Gold goes up aggressively, violently, and persistently, because gold is the ultimate hedge against the destruction of purchasing power. And right now, purchasing power is being destroyed faster than the government's own inflation statistics are willing to admit. The market is looking at the oil price and seeing tighter Fed policy and deciding that means sell. Gold. What I am seeing is the setup for the most powerful gold rally in at least a generation, because the inflation that higher oil prices are going to produce will overwhelm any nominal tightening the Fed is either willing or able to deliver. Now I want to give you the numbers, because I do not operate on hunches, and I do not expect you to either. Facts are what matter. And the facts around gold and silver right now are both alarming and extraordinary, depending on which side of the trade you are on. Gold prices gained 8.3% during the first 3 months of 2026. That is a remarkable number on its own. But what makes it even more remarkable is that it was achieved despite gold suffering its worst month since 2008 in March. Let that sink in. Gold had its single worst monthly performance in nearly 18 years in March of 2026, and it still closed the first quarter up 8.3%. If that does not tell you something about the underlying strength and demand behind this metal, then I genuinely do not know what will wake you up on the week in question. Gold closed at $4,676 after having briefly approached $4,800 earlier in the week, a gain of approximately 5.8% in a single trading week. Silver, which always gets less attention but frequently delivers superior percentage returns, closed above $70 for the first time in recent memory, settling at $72.90, minus gain of 7.2% for the week. But here is where it gets truly interesting, because if you think the gains in the physical metals were impressive, look at what happened to the mining stocks. The GDX, which tracks major gold and silver mining companies, was up 14.5% in just 4 trading days. The GDXJ, the Junior Miners Index, was up 14.8% over the same period, 14 to 15% in 4 days. And here's the critical piece of context that changes everything about how you should be thinking about these numbers. Despite that near 15% surge, the mining stocks are still substantially below their February highs, significantly, materially, undeniably below those highs. That means even after one of the best weeks the sector has seen in years, mining stocks are still cheap relative to where gold is trading. The market has not fully priced in the new gold price reality. There is still an enormous gap between where these stocks are trading and where they should be trading, given the price of gold and silver. That gap is your opportunity, and gaps like that do not stay open forever. Now let us zoom out to the geopolitical picture, because no serious analysis of gold in 2026 is complete without confronting the Iran conflict and what it means for the dollar's long-term role in the global financial system. Here's what happened in March and why it matters. When the conflict with Iran broke out and escalated, gold sold off. It sold off hard. Investors who were sitting on enormous profits from gold's best year since 1979 in 2025 needed liquidity. Fast in gold was the easiest, most liquid asset they had to sell. So they sold it and gold dropped. And people looked at that and said, see, gold is not really a safe haven. That conclusion is completely wrong. Gold sold off not because it failed as a safe haven, but because it had succeeded so spectacularly in 2025 that it became the source of cash for investors desperately trying to cover losses elsewhere. That is a technical event, not a fundamental one. And the distinction matters enormously. Now, since that March low, gold has recovered aggressively, and there's a very clear reason why it will continue to do so. The Iran situation has done something that no Federal Reserve policy decision, no Treasury announcement, and no G7 communique could accomplish. It has accelerated the de-dollarization trend that was already quietly building beneath the surface of the global financial system. Think about what is actually happening here. The United States committed its military to a conflict in the Middle East, created enormous disruption in global oil markets, nearly closed the Strait of Hormuz to commercial traffic, and then, according to the president's own statements, declared the mission sufficiently complete and told the rest of the world to sort out the oil supply problem themselves. The allies who have been financing American trade and budget deficits for decades, who have held U.S. treasuries as their reserve asset, who have priced global commodities in dollars, those allies are watching America say, we fought our fight, you clean up the mess, and they are drawing conclusions. The conclusion they are drawing is that the dollar-centric global financial order cannot be depended upon to serve their interests. And when major economies around the world reach that conclusion, even slightly more firmly than they held it, yesterday, they began to quietly reduce their dollar holdings and increase their gold holdings. Central banks have already been doing this for years. The Iran conflict has just given them another very compelling reason to accelerate that process. Goldman Sachs analysts understand this dynamic. They maintain their 2026 year-end gold price target of $5,400 while explicitly citing continued central bank buying as one of the primary drivers. Central banks are not buying gold because they read an analyst report. They are buying gold because they are managing sovereign wealth and they do not trust the long-term stability of the dollar-denominated system. That is not a fringe view anymore. That is the policy of major economies, and it is one of the most powerful structural tailwinds gold has ever had behind it. Let me now talk about inflation, because I think there is a stunning amount of willful blindness around this topic, and it is going to cost ordinary people dearly. The word stagflation has started appearing in serious financial conversations again, and it should terrify every person watching this video who has significant holdings in cash, bonds, or any dollar-denominated fixed income asset. Stagflation, for those who need the reminder, is the combination of economic stagnation with persistent high inflation, the worst possible macroeconomic environment for most conventional investments, and historically one of the best possible environments for gold and silver. Here is how we get there, from where we stand today. Higher oil prices are feeding directly and immediately into the consumer price index through fuel costs and transportation costs. But the secondary effects are actually more destructive and more persistent than the direct oil price impact. Fertilizer costs, which are heavily tied to natural gas and oil prices, are surging, and fertilizer costs feed into food prices with a lag of several months, meaning the food price increases we are going to see through the summer and fall of 2026 have not even fully materialized yet. Coffee prices are already at levels that would have seemed absurd 2 years ago. The entire agricultural commodity complex is under pressure. Simultaneously, the conflict in Iran and the disruption to Middle Eastern trade routes is affecting supply chains that the global economy has spent decades optimizing to run on minimal inventory buffers. And when those supply chains are disrupted even slightly, the price impact is outsized relative to the underlying physical shortage. Because the entire system is calibrated to run lean, all of this feeds into higher measured inflation. And here is the trap the Fed is sitting in. It cannot raise rates aggressively enough to crush this inflation without simultaneously triggering a severe recession. And it knows it. The budget deficit is already widening because military spending is consuming resources at a pace that peacetime fiscal frameworks were never designed to accommodate. Higher interest rates mean higher debt service costs on a federal debt that is already at levels that generate serious concern among sovereign debt analysts. The Fed is caught between its two mandates, controlling inflation and maintaining employment, in a way that makes both simultaneously impossible to achieve. The result is that real interest rates are going to remain negative or marginally positive at best for the foreseeable future. And the period from now through the end of 2026 is going to see real rates that are significantly lower than any mainstream forecast predicted at the beginning of this year. And when real rates are deeply negative, when inflation is eating purchasing power faster than savings accounts or treasury, bonds can replace it. There is one asset class that has proven its value across centuries of monetary history. I should not have to tell you what it is, but apparently a significant number of investors still need to hear it. Let me get into price targets and the action plan, because identifying an opportunity is worthless if you do not know what to do with it. Peter Schiff, one of the most prescient voices on gold and monetary policy, has publicly stated his expectation that gold can rise back above $5,000 by the end of April. To be clear, that would represent a move of approximately 7% from the $4,676 weekly close we just discussed. Is that aggressive? Yes. Is it impossible? Absolutely not. Given the magnitude of the sell-off in March, that should not have occurred based on the underlying fundamentals and the degree to which the market has yet to fully reprice gold at these levels. Goldman Sachs, which carries somewhat more institutional weight than a single commentator, maintained its year-end price target of $5,400, supported by two pillars: continued aggressive central bank buying, and the expectation that the Federal Reserve will ultimately deliver rate cuts as the economic pressure mounts, even if Goldman's target is directionally right and the timing is approximate. The implication is clear. Gold has substantial room to run from current levels, but physical gold is not where the most compelling mathematical opportunity exists right now. The mining stocks are where the asymmetric upside lives, and here is why. When gold was trading at lower levels, the mining stocks traded at certain valuation multiples based on their profit margins. Why? Now gold is at $4,676. Gold and silver revenues for these mining companies have increased substantially, but their operating costs have not increased proportionately, even accounting for the modest increase in energy costs from higher oil prices. That means profit margins for well-run mining operations are expanding significantly, and the stock market has not yet caught up to that reality. The GDX and GDXJ, even after their nearly 15% gains in 1 week, are still trading well below their February highs, despite the fact that gold is trading at levels that justify significantly higher valuations. Silver at $72.90 is also presenting a compelling opportunity, because silver consistently lags gold in the early stages of a precious metals bull run and then catches up explosively in the later stages. Gold has been the leader. Silver is showing signs of following, and the silver to gold ratio still suggests that silver has more percentage upside than gold from these levels. The question I am asked constantly is, how much of a portfolio should be allocated to this sector? And my answer is always the same. I cannot tell you a specific percentage appropriate to your personal financial situation, but I can tell you that if you are holding significant cash right now, you are losing money in real terms every single day that you wait. Cash is not a safe haven in an inflationary environment. It is a slow motion wealth destruction machine, and the Federal Reserve's policy trap means that the inflation destroying your cash is not going away anytime soon. The mining stocks, GDX and GDXJ, are the leveraged expression of the gold price move. Physical gold and silver provide the foundation and stability. Anyone who held both coming into this week just had a week that dwarfed the stock market's performance by a factor of 4 to 6 times. And the people who were watching from the sidelines are going to have to decide whether they want to keep watching or whether they want to participate. Here is where I leave you. And I want you to pay close attention to what I say next, because this is the moment that separates the people who build wealth from the people who simply observe others doing it. You now have the analysis, you have the numbers, you have the Fed's structural trap laid out in plain language, you have the gold price targets, the silver opportunity, the mining stock thesis, the geopolitical tailwinds, and the inflation mathematics. You have everything you need to make an informed decision. The only variable remaining is whether you have the intelligence and the courage to act on what you know. Markets are not democratic and they are not fair. They do not reward good intentions or careful consideration that never converts into action. They reward people who see the setup, understand the asymmetry, and move decisively before the rest of the crowd figures out what they are looking at. The crowd is still arguing about whether gold can hold $4,500. Meanwhile, the people who acted on this thesis weeks and months ago were sitting on gains that their friends cannot explain. This is your moment, not tomorrow, not after the next Fed meeting, not after you talk it over with your cousin who watches CNBC. Now leave a comment below telling me whether you are already positioned in gold and silver or if you have been watching from the sidelines and today is the day you decide to change that. Subscribe to this channel if you have not already, because the next development in this story is going to move fast, and the only people who will be ready for it are the people who are paying attention. The financial reset is not coming. It is already here. The only question is which side of it you end up on.